Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class on understanding the economics calendar. Now, for those of you that have not come to our webinars before, ETX is a regulated provider, so therefore I'm required to give you a risk warning. So let me read that and get it out of the way. Trading in financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors and do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned tonight are for educational purposes only. Now, ETX is a fast-growing financial services company based in London. We are authorized and regulated by the Financial Conduct Authority, the FCA, and up until January, binary options were not a regulated product, but now they fall under the auspices of the FCA. So everything that is available through ETX, whether you're doing CFD trading, cryptocurrency, binary options, or forex trading, are all regulated products. And we're also a member firm of the London Stock Exchange. When you trade with ETX, you can use our brand new Traders Pro platform, or you can download the professional MT4 platform, or up until the end of this month, you can actually trade on the ETX binary, but we will be discontinuing the binary options product by the 1st of next month so that you can spend your time trading CFDs. Now, tonight, we're going to be talking about the economics calendar. Now, the economics calendar is a fundamental analysis tool for traders to position themselves to take advantage of future currency movements. The economics calendar, which is published daily, is a main trading tool for traders that use fundamental analysis as signals for exiting and entering trades. Economic and political news can change the direction of an asset in seconds, and fundamentals that are true in one instance can be rendered absolutely meaningless by fresh fundamentals a few seconds later. The economics calendar enables traders to keep track of economic indicators and political events that impact asset movement on a scheduled basis. Now, most traders aren't even aware that such a thing exists that puts together all the economic events going on around the globe and keeps you up to date on them. But there is such a calendar. Now, you can get it many places. The economics calendar is a standard tool. It is not an analytics tool that is analyzing and giving on one website, giving you some data, on another website, giving you another data. The economics calendar is a calendar of events that are scheduled to happen. Okay. All of these events are rated in a standard 3-tier rating system, not rated by a particular website, because all the data coming to these economic calendars come from the live feeds that are being sent out to the providers of the economics calendar. So each calendar, and you can find them on FX Empire, FX Street, Investingcom, all of these calendars have basically the same data because each brand that's offering them can do their own creative stuff with colors and backgrounds and all that. But they have to accept the data because this data, there's no website that's getting data itself. The data is coming by live feeds to the websites. Now, there are a couple different major issuing agencies like Thomson Reuters or Platts who issue data directly. So sometimes you might see some differential in parts of what we call the forecast, because whether they're getting the forecast from Bloomberg's or they're getting the forecast from, but the forecast is only a projection before the event. And we'll talk about that in greater detail. But it doesn't matter really where you're getting your economics calendar from. The important news in trading for the forex market is programmed months in advance. Traders will know when there's a meeting of the European Central Bank to discuss policy. And you'll know exactly the time that it's going to take place, the date, and this gives traders time to do some research and analysis to position themselves accordingly. And it's one of the nice things, it's one of the few things that you can incorporate into your trading, because the markets, as you know, are erratic. They go up and down, they're moving with price action all the time. And there's very few events that are actually timed, that you actually know when they're going to happen. In other words, when Donald Trump comes up with some crazy speech or some Twitter thing or says something crazy that's going to send the markets tumbling, we have no idea when he's going to do this. Okay. When Theresa May, has a press release in the UK, we have no idea when this is going to happen, when they're going to make headlines. We have no idea, unfortunately, when a terrorist event's going to happen, or the pipeline bursts, or we have some military action somewhere that affects the markets. But economics data is programmed months ahead of time. So it's very rare that we have the opportunity that we can actually know at 2 p.m. on Friday, this event's going to happen. This is what's expected. This is what the outcome could be, and give you enough time that you can actually do research and analysis and be prepared for the event. And so the economics counter is one of those tools that we can use that makes sense to us and gives us time to understand or learn ahead of time and be prepared. So actually what you're looking at the moment is this week's economics calendar for the major events on the schedule. Now, the calendar we're looking at the moment comes from FX Street. Okay? And we're going to be looking at live calendars, and we're going to be going through the data provided on the calendars in a minute. Okay? But when an economic release comes out, markets can react violently as traders enter and exit positions based on the new information. Some news releases are more important than others, like the non-farms payroll report or the central bank announcements, and they typically move the needle more than most. There is good reason for this. Central bank announcements like rate hikes directly affect money supply, which has a major bearing on the economy, while CPI, which is inflation figures, or unemployment numbers can influence central bank policy. So let's go over to a live calendar and let's learn how to read one of these calendars so that we can start using it in our everyday trading. So we're going to go look at the economics calendar on Investing.com. Okay. And it's just one of the ones out there, like I said, where we were looking at FX Street a minute ago. And now we're looking at Investing.com. And what we can see is they look different because there's a different graphics designer. Okay. But they also have the same information. 5 a.m. today, we had confidence index out of Japan. At 5 a.m., we also had leading indicators. At 2000 tonight, we had U.S. consumer credit. We see that the previous, the consensus, the actual, and the actual is the actual. It's the number that comes out from the releasing agency. The previous is the number that comes from the releasing agency. So whether we're looking on either one of these calendars, we're going to see the same information. Now, the first thing you need to do when you use an economics calendar is go here and set your local time zone. Okay. Because you don't want to make a mistake and misapply a time differential and make a mistake in when you're expecting something to happen in the markets. And the only thing you're concerned with is what's going to happen based in the time in your hometown that you're looking at on your watch or your clock. So you want to set this, and all the websites that offer calendars will have something that allows you to set the time. Once you get the time set, you also want to set some of the filters, because if we don't filter this data, okay, it can be very long and cumbersome, because every country is releasing tons of data every day. So here we've just got the major European and Asian countries in the US, and look at all this data. You get lost in it. So we want to filter down the information. Okay. Because you don't need to see what the unemployment rate is in South Korea unless you're trading something in South Korea or the Korean won. You don't need to see economics data out of the Philippines, and you sure don't need to see it out of Brazil because it has very little effect on any tradable assets. But the economics calendar and the economics data being released wasn't set up or designed for forex traders. This economics data is released by countries all around the world, okay, because it's all the statistics that they need, okay, for everything and anything. If you're a healthcare worker or you're somebody in human resources and you're looking at a jobs report, you're going to look at a jobs report much more different than I'm going to look at it, how it's going to affect the US dollar. Because you don't care how it affects you. You want to understand, are they hiring in this sector? Are they hiring in that sector? You know, if you're providing healthcare workers to the market, you want to know if the salary base is going up to healthcare workers. You want to know if the demand is increasing, or maybe there's high unemployment in health, because this is what you're concerned with. If you're part of a senior agency, maybe you want to be concerned with how many people over 50 were being hired. Okay, but it doesn't affect the financial markets. But the data is huge that's being released. The statistics are huge because the data isn't being created and released for just you and me. Now, the economics calendar on the financial websites have sorted out the data that has an effect on the financial markets. So that's why when we go to the filters, you can actually see the data that we're pulling in. Employment data, credit, balance, economic activity, central banks, bonds, inflation, and confidence index. So these are the only data that we're pulling into the financial calendars. Now, for instance, bonds, unless you're trading something with bonds, they have very little effect, especially at ETX, on CFD prices or forex prices. So you don't need to see them. So you can discontinue them. Okay. You see all of these countries up there. There's nothing on the ETX platform that you're going to trade that's going to be affected by Indonesian data or Filipino data or data out of Qatar or Saudi Arabia. Okay. So we can take this data off of our calendar. We simply sorting it off of it. You can always add it back on if you need to see it real quickly. But you want to limit the data you're getting so that you're not inundated with data. Okay. And this is only the bare basics here. Now, the thing you have to know is that economics data is rated. And it's not a rating system that's left up to the websites pushing it. All the data around the globe is rated into a 3-tier system. The way we can explain this tier system is the most important data, the data that will most likely move the markets or that people around the globe are paying attention to, is considered level 3 data. It's very, very important data. And for us in the financial market, this is data that will move assets. Then we have level 2 data. Level 2 data is important data, and a lot of times that report is a sub-report of a bigger report. And it's what we call the headline data. So you can have a headline or a main, like when we look at the jobs release, that what's called the non-farms payroll report out of the US, we get wages, we get new jobs created, we get non-farms jobs, we get the unemployment rate, and we get the total hours worked. Those are just the headline reports. So that's 5 major reports that are included in one data release. Now, 2 of those are level 3, which is the unemployment rate and the new jobs created. All the rest are level 2. They're important pieces of information, but not critically on their own. Okay. Then you also get lots of level 2 data, which is important data by itself, but is not critical to the markets or will not move the markets on its own. But it's important data. Like today we had building permits. Now building permits, is, if you understand them, is part of a cycle. Okay. You get new sales, you get housing sales, you get existing home sales, you get new home sales. Okay, you get building permits and you get mortgages. Building permits are usually issued anywhere from, and they're only, building permits are on residential construction. Building permits are usually issued anywhere from 30 to 90 days after a contract for a new home is signed. Okay, but that's not a sale of a new home, because the sale of the new home doesn't take place till the new home is delivered to the customer, and that's after the construction. So then we also get mortgages and mortgage applications. So what we're going to get is somebody's going to go look at a new home. They're going to sign a contract to buy that new home, but they don't buy it till it's finished. But the new home doesn't exist yet. So we're going to get them applying for a mortgage. So we see the mortgage applications. The more mortgage applications we get, the more we know people are buying up houses that are to be delivered at a later date. Then when we see the building permits issued, we know that the actual construction is starting on those houses. And then we can gear and estimate when the actual completion will be done. And that's, between 90 and 90, actually it's not 90, it's 6 months to a year. And we'll get the actual sale of that house. So there's a whole cycle. So if you understand these events, you can put them into context. So like we see right now in Canada today, we had building permits issued and it came out much higher or better than expected. So that's very good for the housing market. But that's unimportant. As we can see, it was a level 2 event. Okay. So we have level, and then level 1 events are tons of them, because governments are always releasing tons and tons of data. But level 1 events are events that happen, but they're insignificant on their whole to the financial markets. But you should at least be aware, and if you're trading a specific asset, like for instance, if you were trading building stocks, builders, contractors, and you were looking at, say, perhaps buying a stock in one of the major builders, and you saw building permits come out that high, you might say, it's a good time for me to invest in that builder that I was looking at, because if the market's doing well, the home building market, the home sales market, then his stock should be going up in value. So it can be applied to the markets in different ways. So let's start out with how we look at this calendar. So once we set the time in the filters, we see the time of the events here, and this would be in your home time zone. We then see the currency that would be affected. Now, this used to be uncomplicated and has gotten fairly complicated with the growth of the Eurozone, because we have lots and lots of countries that are releasing data that affects the data, but it only affects one currency, which is the euro. Now, the thing you have to know is most economics data from the Eurozone doesn't really have a direct effect on the euro, even if it's a level 3 event, unless it is ECB data or it's data out of the leading economies in the Eurozone. So in other words, German data will have a big effect on the euro because it's the largest economy in the Eurozone, where Italian data has very little, Spanish data has very little, because they're small economies, and even if it does very badly, it doesn't really affect the whole Eurozone, and therefore it doesn't affect the euro. So now that we have so many countries, we now see the country releasing the data as well as the currency that's being affected. This one, and now the columns don't have to be in any specific order, but the natural occurrence keeps them fairly much the same. So if we see time and currency here on Investingcom, if I click over to Forex Street, you can see that they have time and the currency in the same order, because it's just common sense how people's, how we look for the data. Okay. Then we get the impact level, the importance level, the volatility level, the tier level. All of these sites can give it whatever name it calls for they want to use. They can also differentiate. It's always going to be 1, 2s, and 3s, but here Investing.com uses bullheads. So we have 2 bullheads on this first event. We can see down here we have for the U.S. crude oil inventory, we have 3 bullheads. Okay, if we go to back to FX Street, they use colors and they call it volatility, and they use colors and they use orange, yellow, and red. So you can always find this. They will always have their keys that explain this to you. Okay? But it's the only difference between the two. So what's happened is FX Streets moved the level to the right of the event, where Investing.com has the same information, but to the left of the event. It's just a column. Then we're going to have the important column, and that's the name of the event. Now, every country releases virtually the same data. Not the same day and not the same time, because every country releases different data, different days, different times. They all have their own cycles. But almost all the data is the same, but different names. So like in the US, the major jobs report is called the non-farms payroll report, which is very confusing to people who aren't from the US because it doesn't make sense to anybody. Why don't you just call it the jobs report? Why is it non-farms payroll report? Well, back a zillion years ago, the Department of Labor was responsible for reporting on all jobs that were not related to the farming industry. And the Department of Agriculture and the farm bureaus kept track of all the jobs data and employment data related to the farming industry. Now that's gone away pretty much as all the agencies have merged and the data's merged, but the name of the event became the non-farms payroll report because all the data except for those involved in farming. Okay. But the name has stayed the same, but the data has been merged together. Now that same report in the UK is called the claimant count. And in Australia, it's just called the jobs report. But you'll get to know these after a while. But nobody keeps them a big secret because no matter what website you go to, on the calendar, you're going to see the name of the event. Now, it happens to be that here on Investing.com, if we click on the event, it's going to open up another page that's going to tell you exactly what this data is. So you don't have to remember all of these. After a while, you will. But it tells you all the information you need to know. Okay, if we go to FX Street, again, if we click on the data line, it's going to open up and tell us what it is. You know, they're both very similar. They all do the same, and then they all have some charts and some information below. Now, the charts and information below are going to become important to us when we have to start using this to make decisions. So we have the time, the currency, the importance level, the name of the event. Now we're going to skip all the way to the right-hand side. Now, we notice here we have previous, forecast, and actual. Again, if we go to FX Street, we have previous, consensus, actual. Again, simple variations of names. Now, the easiest one to understand is previous. The previous is the number that was released the last time this event took place. So in other words, we're looking at German industrial production, the first line here. And if we go over to the previous, we can see that it's in red at the moment. Okay, because that's telling us at this last event today, when this data was released, they also made a revision to last month's data because the data is so up to the minute that the reporting agencies don't always get all of it in, and they're doing statistical analysis all month. And the next month, they can release a change to the previous months. And you will see that under previous. If previous is in red or green, it tells you it had some adjustments. You see down here at the Halifax Housing Price Index, it's just 2.7. That data was what it was when it was released last month. On the German industrial, the first line, if we put our cursor on it, we can see it was at 3.4%, but it was revised downward. It was a negative because it's in red, downward to 3.1%. And this is crucial because these revisions downward have an effect on the markets as well as the most recent release. Then we come over to the next line, which is called the forecast here, or the consensus on the other. Now, this is the only place that you might see a slight variation from website to website, because the government and most of the major reporting agencies like Thomson Reuters, Platts, they don't release forecasts. They don't do, they accumulate the data and they release the data. The forecasts come from forecasting agencies. Like a lot of times you'll be reading in Bloomberg, you'll be reading in Financial Times, our group of analysts expect this report to come in at minus 0.4%. Bloomberg's might say our survey of 36 economists say we expect this report to come in at minus 0.3%. So you might see some variation in the forecast, but that's only a forecast. It's not gospel. The gospel comes when we get the actual. And this actual comes directly from the releasing agency. And if we, again, click on this box in the center, it tells us who released the data and gives us a link to the website of the releasing agency. So this is German data, and the German Statistics Bureau is, I don't even know how to say it in German, but it's Distasis. And if you click on here, and you should one time click on the link, and it'll take you over to their website where the actual full releases. And sometimes if you look at these releases go on for pages and pages and pages and pages of nothing but boring data. But sometime you should look at them. But you can then see what government agency or what private agency is releasing the data. So we go down here to US crude oil inventories today and click on it. We can see that was released by the Energy Information Administration. Now, it's not always important, but we do want to make sure, okay, because some reports are released by private agencies and other reports are released by governments. Although today, everything is looked at as the same because the major reporting agencies actually collect the data better. But like the Wednesday before the non-farms payroll report, we have what's called the ADP payroll release. Well, that's released by ADP, which is automated data processing, which is the largest payroll processor in the US. And they use all the data from all the payrolls they process and an algorithm to give us some pre-information about what we could expect the government to release on Wednesday. But you'll get to know all this stuff after a while. Okay. Now, we've got the previous, the forecast, and then the actual. So this is what appears on your calendar. Now, let's get past this. Now you know where to find a calendar, how to set it up, how to read it. Now you have to start learning how to use it. So let's go back to my PowerPoint. And I'm going to tell you a story about your kids and their report cards. Because if you think about economics data, it is basically a report card on a certain sector of the economy. So now you're sitting down to Sunday dinner with your son. Okay, or your daughter, it doesn't matter which one. Okay. And you know, your kids are pretty good kids. You never have problems with them. They're all right. No, you're proud parents. And you say to your son, well, kiddo, report cards are being released on Wednesday. So what is that? We now know the economic event is scheduled for Wednesday. We now know he comes home from school at 3 o'clock, so that release time will be 3 o'clock. And what is it? It's second quarter report cards. So we have the time. We don't have a currency, but it's your family currency. We have the level of the data, and we know it's important data, and we know the data is for second quarter report cards. So you say to him, well, kiddo, last semester you brought home 4 C's and 4 C minuses. And he says, yes, I know. So what is that? That is your previous. Now, the thing about the economics calendar, just like your report cards, is you know that he brought you home this, and this is a very average or slightly below average report card. But you didn't do any research. You didn't call the Board of Education to find out how many students got C's and C pluses and C minuses. You didn't go to see the principal at the school. You didn't find out that maybe they brought in a harder program for kids in his grade because they were wanting to increase their reading and math levels, so they were grading them harder. No, you didn't do any analysis. You just took the data and reported the data. That's what the economics calendar does. The economics calendar doesn't analyze data. So you're getting straight facts, which helps you, because when you know you're getting real numbers, you can then use those numbers properly. Now, you say to your kid, because you trust your kid, how do you think you did this semester? He says, well, Mom and Dad, I think I did a little bit better. I think, if anything, I'm going to bring you home maybe 1 or 2 B's and mostly C's. I don't think I'm going to get any C minuses. Okay. Now, that's the forecast. But because you trust your son, he's, straight-headed and level-headed with you, so you set your expectations based on what he told you. Now, again, you didn't do any evaluation. You didn't go back and check out what the other students were predicting. You didn't go find out whether the PTA had a meeting about harder grades or bell curves or anything about this. Okay, it's just now you set your expectations based on this forecast. So what do we have on the economics calendar? We have the previous and we have the consensus or the forecast. Now, come Wednesday afternoon, your kid comes in the back door at 3 o'clock and hands you the envelope with his report card on it. But you see, he scoots right out the back door to play soccer with his buddies. Now, you open up the envelope, look at the report card, and your kid brought you home straight B's, 8 B's. You're ecstatic. You get on the phone, call your husband, tell him how great your kid did in school. You can't wait to go to see your neighbors the next day and to brag about your kid. You're thrilled to death. You're ecstatic. You're having a very big reaction. Why? Well, first of all, it's a good report card, but it's also much better than your expectations. If you would have brought you home a report card that had all C's and 2 B pluses, exactly what you expected, you might have been happier because it was better than last semester, but it's what you expected. So your reaction would have been very small. But when the reaction or when the actual is much better or worse than expected, you have a larger reaction because you're human beings. Now, if he had brought you home 3 B's and 5 C's, your reaction wouldn't have been enough to make it a tradable event, but you would have been happy. But all B's makes it a major event. So you holler out the back door, hey, kiddo, we're going to go over to the mall and you can go to the sporting goods store and buy that soccer ball you've wanted. And then I'll take you over to McDonald's where you can get your favorite burger for dinner because you're thrilled to death. And this is what happens. You have immediate response. You have an immediate reaction in the markets. And if it's a good event, you can measure this event or estimate how good it is. And then you can trade the appropriate assets. Now, what happens is 5 minutes later, that soccer ball comes through the dining room window, shatters the glass all over the place, and you're having a fit. You holler out the back door and tell the kid to get his butt in the house. Report cards are long forgotten about. Now you're yelling at him because you've told him over and over and over not to play soccer on that side of the house. You tell him he's got to help you clean up the glass. You're not going to the mall because now you got to call the handyman to come board up the window and make arrangements to have a new window put in tomorrow. And it's going to cost you money, so he's not getting his new soccer ball. And you've already forgotten about his report card. Now, granted, tomorrow, after the window's fixed and everything's done, you're not going to be mad at him anymore. And when you run into your friends at the shopping mall or at the grocery store, you're going to start bragging about his report card. He did so well, and you're going to feel very good about it. And that's what happens with assets also. you have initial knee-jerk reactions, but a smarter trader waits for all the stuff to clear out and looks for the new level that that asset will hit. So there's two different ways to trade. You can trade that initial volatility, or you can see whether it was a good piece of data that will eventually give the euro or the pound or the dollar a slightly higher level after the volatility is cleared out. But remember, the markets react just like human beings react. So we have to learn to build what we call market neutral, market negative, and market positive. These are the numbers around which you would expect market reaction. We do this primarily with level 3 events because they're the easiest to trade. Now, what we have to do is go back to our calendar and understand that event. So let's just stick with this German industrial production across the top line. Okay. And what we want to do is go back and open that hyperlink because we need to take a look at some things. We need to look at all the calendars will give you a chart. Okay. We need to look at how that data has been over the last few months and to see if there's any rhyme or reason or expectation, like is the data steadily moving upward? Is it down? Here we can see in German industrial production, it's all over the place. We also need to know how big of a difference it is. How does it report? Does it report in tenths of a percent or only stays between minus 1.2, 1.3, 1.4? What is the average or what do we expect? What's the variables? So we can also see that on the last 6 months of release. We can see the previous, see the forecast, and we can see the actual. Now we can see in this German industrial production, it's all over the place. And it also, we can see that the forecasts never seem to be right. So how do we determine what we would think would be a starting point to evaluate where to trade this? So if we look at the forecast as minus 0.4, okay, how do we decide what to trade this at? Well, in this case, I would say this event is basically untradeable because we can't tell what the volatility is because we can't tell where the data is because it's all over the place. So let's look for another event. So let's go back down. We were looking at building permits out of Canada. And if we click on that one, because not all events are tradable, okay, we have to first look to see if there's any rhyme or reason that we can trade. Again, now we can see in the, again, this is another report that's all over the place, but we can also see that this data has been steadily moving upward. And for some reason, it's always got upward revisions. We can see in the previous, it's always revised upward. And that means for some reason, this data is reported very late. We can see on the whole, some months it's very good and some months it's very bad. Now, this is the thing you have to understand. Building permits are very much tied to the weather and the time of the year. So what happens in Canada, where it's extremely cold and they have very harsh winters, if they get a lot of cold weather or a lot of snow or a lot of inclement weather in the wintertime, most likely you will see a bad building permit. That doesn't mean the houses haven't sold. It means the builders aren't pulling the permits because they can't start the construction because they got to wait for the snow to clear or they've got to wait for the weather to warm up a little bit. And also towards the end of the summer or the end of the fall. If they're expecting an early winter, they're not going to pull a building permit in September and October to be building in November, December, January, the worst. Just like if you look at housing starts in Florida and in Texas or the south part of the US, during hurricane season, you won't see builders pulling the permits because they don't want to have constructions 1 or 2 or 3 months underway if a hurricane rolls in. Now, they don't care if a hurricane rolls in if they pulled the permit 6 months ago because they've got the house built well enough that it will withstand the hurricane. But they don't want to have a whole bunch of just starting stuff out there and building materials out there on the property that are going to get whisked away. So you have to understand how to look at this data. And you look at this data, and that's the nice thing. You have the chance to do some analysis, as well as look at some old news articles, as well as looking at the report, as well as looking at the data releases and trying to analyze them. So if we were to look at the weather for Canada, we would probably see that they're expecting an early spring. The weather in February hasn't been too bad, and they're not expecting any major snowstorms in the end of February, the beginning of March. So therefore, the builders are starting to pull the permits so they can start arranging the construction, because they can't start construction until they get the approved permit. So we need to build our market neutral, our market negative, and our market positive. So we would do this by looking at this event, and here we were expecting a release of 2%. Now, how do we know how big of an event or how big of a market reaction? Well, we're only going to get a really strong reaction, especially on an event like this, if it's really much better than expected. So we could say between 4.0 and 0.0, it's not tradable. Okay, there's no available trade for us. But we can say if the event comes in better than 4%, when the markets are only expecting 2%, that's going to be very good for the Canadian dollar. And in this case, we got not only 4.8, which is much better than expected, we got an upward revision to last month, which was a very, very weak month, and it was revised up a little bit better. So this should have sent the Canadian dollar up. And as we can see, the US dollar, Canadian dollar picked up 75 points today. Not a big increase, but if we actually look on the chart for the calendar, we can actually see the economics data releases and see what happened when the release came out. Right on the calendar. Okay, and we can see how the asset reacted to that data release. But this is how you start using the economics calendar, start using it into your trading decisions. And you'd be surprised after a while of practicing with it, because I don't think anybody should start trading with it the first day. But after a month of just practicing with it, because you see all the same events cycle through each month, and you'll start to see which events have the biggest effect. You'll start to see how the markets get affected by the events, because again, you know exactly what time it is. You can see everything's been released. You can watch the charts, and then you can start learning and say, okay, so when this jobs report comes out next month, I kind of know what to do because I've already done my research. I already know something about it, what the ranges are, what the expectations are, and I can start making some trading decisions based on that. So hopefully I gave you some type of general understanding on how to use the economics calendar, how to track these events, and how to incorporate these into some of your trading strategies. Excuse me. This webinar has been recorded, and if you want to see a recorded version so you can listen to my explanations again, just use the same link you did use to come to tonight's class in about 24 hours. Thank you very much, and thank you for supporting ETX, and have a very nice night now. Bye now.